Hello and welcome. In this video we will talk about a topic in the field of banking, or to be more specific, bank steering. We will take a closer look at credit spread risk management. In particular, why does it matter to banks? Before we delve into details, let's emphasize a moment on the definition. Credit spread risk refers to the potential for the difference, or spread, between the yields of credit instruments, such as bonds but also loans in the wider sense, and a benchmark interest rate to widen or narrow. The benchmark interest rate is usually a risk-free rate, such as the yield on government bonds. When the credit spread widens, it means the yield on credit instruments increases relative to the benchmark rate. Conversely, when the credit spread narrows, the yield on credit instruments decreases relative to the benchmark rate. For example, let's consider a corporate bond with a yield of 5% on a 10-year and a government bond with a yield of 3% on the same time frame. The credit spread in this case is 2%, coming from 5% minus 3%. If market conditions deteriorate or the creditworthiness of the issuer weakens, investors may demand a higher yield, say 6%, for the corporate bond. In this scenario, the credit spread has widened to 3% as the result of 6% minus 3%. Based upon what was elaborated momentarily, we can now examine the aspects with respect to what extent banks are affected by credit spreads. Credit spread risk matters to banks for the following reasons. Profitability and revenue generation. Banks often earn a significant portion of their revenue by lending money and holding various credit instruments, such as bonds and loans. The interest rates or yields they charge on these credit instruments are influenced by credit spreads. When credit spreads widen, banks can potentially earn higher interest income on their lending activities, leading to increased profitability. Conversely, when credit spreads narrow, their interest income may decrease. However, what happens to the already existing loans given, respectively, the assets that are held currently? Asset valuation. Banks hold a variety of credit instruments in their portfolios. Changes in credit spreads can affect the valuation of these assets. You are most probably familiar with the concept of the net present value. Future cash flows are discounted by the respective prevalent interest rate to determine the net present value. If credit spreads widen, the market value of existing credit instruments in the bank's portfolio decrease, leading to potential, however, still unrealized losses. Conversely, if credit spreads narrow, the value of these assets may increase. This is the asset side of the balance sheet, but what happens to the liability side? Let's take a look at the liquidity and funding costs. A widening of credit spreads can lead to reduced liquidity in credit markets. This can impact a bank's ability to buy or sell credit instruments at favorable terms. Additionally, if the market for a specific type of credit instrument dries up due to widening spreads, a bank might face challenges in raising funds or selling assets. Credit spread movements can also affect a bank's funding costs. If the creditworthiness of the bank itself is perceived to be weaker, it may need to offer higher interest rates on its own debt issuances, which can increase funding costs. When taking a look at the liability side, it is also of importance to emphasize the own funds or equity. These are determined in accordance with the capital adequacy and regulatory compliance. Banks are required to hold a certain amount of capital to cover potential losses from credit risk. Credit spread risk is a component of credit risk. If credit spreads widen and the value of a bank's credit instruments decreases, it could impact the bank's capital adequacy ratios, potentially requiring them to allocate more capital to maintain regulatory compliance. This is in line with the aspect of asset valuation. Generally speaking, in terms of the risk management aspects, we can state the following. Managing credit spread risk is crucial for maintaining a balanced risk profile. If a bank's portfolio is overly exposed to credit instruments with narrow spreads, it could be more vulnerable to adverse credit events, since this is an indication that an investment in predominantly risky assets is prevalent. Diversifying the portfolio, including safe haven positions, like government bonds, is unavoidable, and hence, actively managing credit spread risk helps the bank avoid concentration in high-risk assets. Last but not least, market perception and reputation. Credit spread movements can also influence market perceptions of a bank's financial health. Widening spreads might be interpreted as an indication of deteriorating credit conditions, potentially impacting investor confidence and the bank's reputation. Let's briefly wrap up by stating the following. Given these reasons, banks actively monitor and manage credit spread risk as part of their broader risk management practices. They use various strategies, including diversification, hedging, stress testing, and regulatory compliance measures, to mitigate the potential negative impacts of credit spread movements on their financial performance and stability. Thank you very much for your attention. We would be happy to see you again on this channel. Keep in touch.